To my right, we have this lovely gentleman, Bob Donaldson. Bob and I have met a few times before, and he is actually Dennis Prager's financial advisor as well. Bob Donaldson is the founder and managing principal of Advisory Group West, which is a wealth advisory firm. Bob is a registered investment advisor, a chartered financial consultant, a member of the International Association of Registered Financial Consultants, and a fiduciary who, for over 38 years, has helped his clients organize, prioritize, and optimize their finances. So please help me in welcoming Bob today.
Thank you. Thank you.
I never really understood the importance of saving for retirement. What can I do and what should I do?
Well, as you can imagine, everyone asks that question. I'm even asked that question by 20-year-olds. And the sooner, obviously, that you start, the better. The magic of compounding is the thing that always makes the difference. If you look at Warren Buffett, he started at age 17. And so when you do that, it's very difficult for that money to not multiply in a marvelous way. So no, of course, it's not too late. The sooner you start educating yourself on those things, the sooner they start becoming less intimidating. And most of my work is actually to keep all the terms and vocabulary and concepts from being intimidating to folks. That's the 80% of what I do is education. So no, get started as soon as you can.
So what's one of the first things that you say to people when you start that educational process with them? What's the first little tidbit of advice?
This actually happens within about 2 to 3 minutes. And the first recommendation is to get a good sense of what it is that's important to you, what is deeply important to you. And so our philosophical approach is that you align your financial priorities to what's important to you. And that, in essence, becomes the wellspring for almost everything else that you do. If you have that right, it is fascinating how everything falls into place. You do need to understand concepts and, as I say, how the world of economics works a little bit. But that really is the most important part. And it's very difficult to have that conversation for most folks. As you can imagine, the 3 subjects that you should not bring up in polite company is sex, politics, and money. And of those 3,
I thought it was sex, religion, and politics. But money is probably in there too.
Money, yeah.
That's all we talked about at the dinner table in my house.
Oh,
Maybe that's why I'm on the radio today.
Right. But money is like a taboo. You can talk about your career, but to talk about what it is you're doing with your money, that is a definite taboo. And it's even, what we find is even when couples come in, we always work with a couple together, a big part of my job is to facilitate that conversation simply between husband and wife, because they don't know what vocabulary ought to be in that conversation.
So you're like a marriage counselor for the financial conversations.
I'm told that, but obviously that is definitely not my profession.
So do you find that typically, and I've heard this from friends of mine that are in the business, and others across the country, that unfortunately sometimes the man is the one that tends to pay the bills, do the budget, and understands what's going on with the finances and retirement. How do you work with women to get them a part of that, to become a part of that conversation so that they're as informed and they're as aware of their financial decisions for their future?
That's a terrific question, because that's actually what we're trying to accomplish in that first meeting, is to allow what I'll call the one who is less interested or more intimidated by the subject, and sometimes it is the man, but you're right, usually that's the pattern, is when the husband actually hears what is deeply important to her, it's usually news. Usually it's news to him.
Like he didn't know her really, priority list.
Yeah, and it's not uncommon to have someone come to tears because it's actually just the first time they've even given permission, if you will, and it feels like it's been permission to actually speak to that, to actually air their fears and their hopes. And that's a huge breakthrough, and that usually happens pretty quickly.
And so what happened to the stock market a couple weeks ago? What do you say to clients at both ends of the spectrum when they're looking at the stock market just go crazy, and then everybody on media is freaking out about it?
As you can imagine, in the educational process, so much of that work has to do with managing our expectations. If you think about it, there's an average of three 5% corrections typically within a year, a 10% correction every 13 months, in essence, once every year.
Wow.
And a 20% correction every 3.5 years. So what you're talking about is very, very normal. So what we experience is that in the absence of a plan, if you don't have a context for taking in new information like that, it is very easy to be just blown away. So all of that has to do with becoming familiar with how to put everything into context, and finally, to answer your question, the current dislocation or correction in the market simply has to do with a miscalculation or a different calculation that's happening in China. China has been for several decades now. Most of their GDP comes from manufacturing, and it comes from infrastructure, and that has suddenly changed. Suddenly, it's become obvious that they now need to change, and they have to change.
Because the conversation was that some of their infrastructure was like the faux infrastructure that they were building just to create jobs, and that's what created.
I'm sure some of it was faux, but the bulk of it, bridges and dams and all kinds of things that are central to develop the country, they've kind of hit bottom in terms of there's not a lot more that they can do that. So they have to shift to a service type of economy. If you remember the United States, obviously, we were a rural country, and then we became industrialized, and so it's just in their development, they're at a different stage, and it's suddenly become obvious. And that's actually, long term, that's a very, very good thing for everybody, that suddenly there's not suddenly, but there's going to be a huge development in another big economy other than the United States, honestly.
So why do we here in the United States, especially on the stock market, react so, I feel like, violently or suddenly whenever something happens in China? Why is there that volatility there? And is it fake? Is it real? Like, how much is it really substantiated, I guess, how much our stock market tries to correct and adjust when something big happens in China?
Well, there's two parts to that question. The first part is that the normal behavior of investors, and I'll use this current period that you're referring to as an example. This bull market that we've had over the last 6 years is the third longest bull market we have had. So when we're always looking, and you already heard the statistics I gave you, how frequently the market corrects, and we haven't had one in 6 years.
So you're saying a 10% correction happens every 13 months?
Historically, if you do the math and you just average them all out, obviously it doesn't do it in a nice straight line, and that's what's disconcerting, is when you've had the third longest bull market, and suddenly there's a change, and it's an unusual change, and everyone was recognizing that it's coming from China. In other words, usually when the United States would sneeze, everyone else would get a cold. And this is the first time China sneezed and somebody else got a cold, and that's a very different shift. So and when that happens, if you've had your money riding for 6 years, the tendency of investors is to shoot first, ask questions later. Mm-hmm. So that's why it suddenly will drop, and they're taking profits. So that's a normal thing that happens, just whether it's China or something else causing that dislocation or that suddenly questioning that the economics and the earnings are going to continue the way they have. So what has happened is there's two things that cause the stock to rise. The first one is earnings. Companies have to first earn money, make profits.
Like Apple.
And there's all kinds of examples on that. The second is when they're earning, obviously they can now employ people, and therefore unemployment goes down. So those are two. Number three is then GDP increases. That's three. That's telling you that there's a recovery.
GDP, I'm sorry, but this is like finance for dummies. Gross domestic product.
Gross domestic product. Good. Thank you.
And Shapiro would have been impressed had I knew that.
And the fourth one is housing. So when the first three are online, housing then kicks in, and you've got a full recovery. So if you reverse those, you've got a recession. So that's the economy. Correct. So we're now talking about corrections. So first there's the economy. The underlying economy can actually continue to be good, and it is in the United States.
Despite the wave of
despite profit taking, despite the normal ebbs and flows. So when you're calculating the price of a stock, you're simply calculating how many years you expect the earnings to continue. So usually the average is in the range of about 16 to 17 times earnings. So what has just now happened is the expectation was that they would be about 17 times earnings, and suddenly the calculation is, wait a minute, the manufacturing portion of our economy, which is only 10% of our gross domestic product, is going to be affected by China. So instead of stocks selling at 17
It's like
times earnings.
how much would
they're down to about 14 and a half or so. So that's reflected in the overall price. It's like big deal, so what else is new? So these are normal. Everything's working the way it's supposed to be working.
So that's what you tell people when they call you and they're like, oh my gosh, the stock market just, like, to them crashed. I mean, it's not Depression era crashing.
Yeah. So the first thing I remind everyone is that this is very normal, and it's possibly a different reason at the moment. I mean, this is a wonderful historical period of the world. I mean, never has the world produced as much wealth as it has. In the last 10 years, there's over 450 million new middle class that have come online, if you will. That obviously most of those are from outside the United States. But that's
Really? So there's more middle class people that have developed in the last how many years?
10 years, yes.
Outside of the United States than in the United States.
India and China being the principal providers.
Why do you think that we're on kind of like a slow rise compared to those other countries? I mean,
well, obviously we had a lot
politicians usually say on the left and the right here at PolitiCon typically say, I'm for the middle class. I want to grow the middle class. The middle class, small business owners, they represent the American economy. So I had no idea about that statistic. It's kind of mind-boggling to me that India and China have now grown the middle class more than the United States has in the last decade. That's fascinating.
Yes. Well, I mean, there was a huge change in both China and India in the late 80s, early 90s. India in particular was a huge change. If you remember, their patrons were the Russians, and they at some point said, we're not going to do that anymore, we're going to go toward the United States, and they changed their approach. They're taking the capitalistic approach, and that made a huge difference. Pardon?
It works.
Yes, it worked. Yeah, that's what they finally said. That's the way it's supposed to be. Yeah.
So what do you think that we could potentially do here in the United States? And this, I don't know, you might find this a loaded question, but to grow that middle class more, that helps stabilize the economy even more?
That I'm not sure of. I don't think in terms of...
When you figured out you should run for president.
Yeah. I don't think in terms of politics. I think in terms of economics and what makes sense. That's what we do, obviously, with individuals. Is the thing that I think would actually help the most is not from top down, but bottom up. The more educated our capitalistic society becomes on an individual basis, the better choices individuals make. That's really where the growth comes from. Usually government just gets in the way by politicians who pretend to make promises that they can't deliver. But I don't want to get into politics because I'm definitely not a political person. I'm typically...
I'll do that for you.
Thank you. Appreciate that. As you can imagine, no client ever comes to me and asks me what my politics is. In 38 years, nobody has asked me. All they care about is, how can you help me? And I don't ask them what their politics are either. And I don't want to know them because it just gets in the way of the conversation.
So you mentioned people's choices there and people from the bottom up needing to make those individual choices and decisions. Why do you think, and I guess my question for you would be, how do you see a way out of the choices that American society daily makes to be this kind of credit card society and this debt-ridden society? How do you get out of that mentality and have people live, I guess, more responsibly so they're not doing this whole paycheck to paycheck thing and then they can prepare for their future?
Well, it goes back to the conversation that I was alluding to earlier, is when you actually just stop the noise and stop the advertising smack in your face all the time, and you just say, what is it that's deeply important to me? So here you are, you just revealed to me, hey, I'd like to be able to do things. Well, the only way to keep from being distracted by somebody else's plan is to have a plan for your own life.
So you can't walk around without a plan?
I suggest not. Yeah. It's impossible to measure your progress if you don't have a plan. If you don't have a y-axis on your chart, you can't compare. You can't measure where you are. So that's usually what happens, and I'm always teasing my sons and reminding them that if you don't have a plan for your life, somebody else does. And if you don't like that plan, you better get a plan for yourself. So the same applies. They always roll their eyes when I say that, but that's the actual truth. So most people are simply, whatever shiny object shows up in front of you, if you don't have a plan for where you're going, that's going to obviously distract you.
And how easy is it for somebody to come in and sit down with you and come up with that plan? And then how quickly after do they see results of that plan taking action and growing?
That's a great question, and I wish people understood that how easy it is. First, it's quite a revealing and energizing conversation simply to come to terms with and to literally hear yourself verbalize. It literally comes out of your mouth and into your ears. That's really what's important to me, and that's really what will fulfill me. And the energy level quickly rises where people, what do I do now? What do I do now? What do I do now? And to answer your question, I actually have to slow the process down. I have to slow, because you need to understand.
So people get so excited that you're telling them to hold up?
Yes.
Wow.
That is most of what I have to do is say, teaspoon at a time, because there's a lot of education to do. It feels, a lot of people have asked me, why don't you teach and go into education? Well, and I'd love to. That's all I do all day is educate. But I find that if you're not ready to hear it, you're not going to hear it. So just to speak to a classroom of people, one or two might be interested. So I'd rather focus on them and actually get traction with them and momentum with them and have them shine than deal with a whole bunch of other people who really don't want to hear it at the moment.
Do you think it's possible to live in California and plan on retiring and living out the rest of your years in California? Or do you think because that money can go so much further in places like Texas that we're at risk of losing an older retiring generation to another state?
No. The answer is yes, you can stay in California, and I recommend you stay in California if you're in California.
I mean, it is beautiful.
Think about it. If you spin the globe, where do you want to be? You want to be in the United States. And if you're going to be in the United States, the richest state is California. So I'm going to be in California if all the money is in California. But anyway, to answer your question, yeah, you can imagine 95% of the clients that I have are obviously in California. So yes, you can get it done. You can get it done. And when you find out that you can get it done, it's usually surprising and delightful for people to find out that, yes, they don't have to move to Missouri or to Texas.
Well, let's delve into politics a little bit.
Okay.
We've heard a lot of people's different tax plans and a lot of people's different plans about what they would do when they're president.
I have to be frank with you. I don't believe the politicians. Usually, what I take some heart in is that it has whatever it is that they promise and whatever it is that they put out there. It has to go through the grinder of Congress. And my hope is always that, in the end, whatever comes out is always a variation on it. I'm a great believer in, and I always take solace in Winston Churchill's quote where he says, "Americans always do the right thing after they've tried everything else." So that process, that messy, loud, noisy process, is what gives us and continuously delivers to us the progress that we've made, and that's why we are the example for the world, even though it is really, really messy. So I try not to get distracted, is what I'm trying to say with politicians.
So on election night in November 2016, we're going to see the next morning when we wake up, that Wednesday morning, we're going to see probably something happen in the stock market. Typically, and even though I'm not that much of a financial genius, as a political geek, I always notice the day after an election day, whether it's the midterm elections or the presidential election, you always wake up on Wednesday morning and something's happening in the market. Why is that, and should it be something that investors pay attention to?
That always happens because, especially business, detests uncertainty and insecurity. So people can be over-optimistic or over-pessimistic as to what the future is going to happen, what the future is going to bring economically. It is interesting that if you look at the performance of the market, whether it's a Democrat or Republican that is president, that if it's a second term, so during especially if there's a second term for any president, it's interesting that simply the stability of the same pattern being expected.
People kind of know what to expect.
Yes, that the market takes solace in that and continues to go up. And so another way of answering the question is, it is also interesting. You can imagine all the studies that the financial industry has done on just that question. That
you should write a book on it.
Oh yeah, right. Everybody tells me that. Let me get back to the question.
Sorry.
They've done the statistics of whether a Republican administration or the Democratic administration is better for the market. And statistically, they're almost dead even. Technically, the Democrats do
Not
a little bit better.
the overall economy, but the actual stock market, you mean?
The stock market and the economy,
Really?
which is a function of that. They're really dead even. I mean, it's statistically, as I say, the Democratic slightly ahead, but statistically, it's not a
Since the founding of our country and the stock.
Yeah, which is just that again, that I take solace in that. I'm going.
Because it goes back to your point of don't freak out when something happens, because everything will eventually correct itself.
Well, usually the freak out comes because you don't have a plan. If you don't have some perspective on to take in new information, I'll freak out too. And I did. When I was younger, I didn't have a plan, not a good enough plan. And I would freak out. So we're always freaking out by whatever wind is blowing if you don't have a context to put it in for you. So that obviously is the message that we're constantly getting out there, is have a plan so that whatever happens, you know what minuscule part of your plan that's going to affect. And it usually is a minuscule part.
Even if, like, my 82-year-old grandmother has money with you, when there is that dip, you're going to call her up and say, don't worry about it.
There's almost no reason for me to call her. Her income will be set up, her taxes will be set up, her cash flow will be set up. I mean, the only thing it's going to affect is the money that she's not going to need, that is not really for her. She's really setting that aside for the next generation. At that age, it's like, no, she wants financial security, please. She wants financial security guidance, not financial gambling guidance. I mean, it's like, it's a different,
You want to gamble, hop in the car and go over to Vegas.
Yeah, Vegas is right there, and lots of fun.
It's like a $75 flight, too. It's not that bad.
Yeah, right.
So when do you think that, so we just had this drastic correction in the market, which you said was kind of like the big one, like that we're waiting for here in California. It wasn't a drastic correction?
No, that's a 10% correction
so that's
after
the
6
normal
years.
13-month correction that you mentioned earlier.
Yeah, it took 6 years.
But it took 6 years.
Yeah.
So then are you afraid that because there wasn't one every 13 months that we could experience another one?
No.
Not at all.
No.
He's so calm. I'm like, okay.
Well, if you've done it 38 years and you've seen all the noise, you know how to filter out the noise. And most of it is noise. And the noise only affects you, again, if you don't have context for it. And it is the lack of that context, the lack of those plans, that causes a person to hit the panic button. And if you don't have a plan, the panic button is the only option you have.
But don't hit the panic button.
Don't hit the panic button.
Is there ever a scenario where you're like, you should hit the panic button?
No, it just happened in 2008.
Okay.
So when the market dropped 50% in 2008, I'm bragging now, guess how many phone calls I got?
Well, how many clients do you have? I can't make an accurate guess without knowing the clients, right?
The bragging is I got one call.
Wow.
And it was actually half a call because it was, his name is John, can't give his last name, but he calls and he says, it's okay, I understand it all. Could you please explain it to Marianne for me again? It was only because they had only been clients for not quite a year. But again, the market only affected a small part of their portfolio. The things that were important to them, and they had just crossed the threshold for retirement. Their cash flow was set up, their taxes were set up. When a person reaches retirement, they don't want to be hyperventilating about what the market's doing or who's going to be president. I don't want to worry about that. I want to go play golf. I want to enjoy my life, please, and thank you very much. That's why I came to you. I didn't come to get more anxiety or more stress. I came to get it reduced. So that's how you get it.
When there is you briefly mentioned taxes there, so I kind of want to hop on that for a moment, if I may. When there's a change in the tax code and there's a change in the tax rate for different income levels and all that stuff, do you see it affecting people's investments overall when they come to you, like what they have to bring to the table?
The tax rates, the fundamentals as to the options, especially for retirees, the options that are available for retirees and for seniors, there's so many different things that they can do. So whether it's going to be 33% versus 35%, it's like you're hyperventilating about very little. When you set up your fundamental cash flow, we set it up so that we take advantage of all the things that can be done to ameliorate the tax impact. So the net effect to the client is, as we call it, the irreducible. We'll get it down to the irreducible, and that's a function of the things that they did beforehand. For instance, I'll give you a simple example. If a client has, say, a traditional pension and all of his or her money is an IRA 401k, there's very little that we can do because everything is taxable. But usually that's not the case. That's actually the extreme. Maybe 2-3% of the folks are like that. So most people will have after-tax dollars in triple tax environments. They'll have some in tax deferred, they'll have some in tax deductible, and they'll have some in tax free. So when you can work with those 4 pools of money, it's just par for the course to set things up so that they get the outcome they want in terms of security of income as well as tax efficiency.
Okay, I think we're going to open it up. If anyone in the audience has any questions for Bob. Anyone? Scott?
Yes, sir.
What's the best piece of advice for finances that you've ever heard, and what's the best piece of advice for finances that you give?
What is the best piece of advice
About your finances that you've heard, and what's the best piece of advice for finances that you give?
It's the same answer. In fact, you can imagine, I'm often asked, especially when someone first meets us, that they really don't understand, haven't gone through the process of planning. The question I'm always asked is, what's the best investment? The best investment is a plan. Even if the plan is not executed well, you are way ahead of where you otherwise would have been.
How do you guarantee that that plan is executed well?
Well, that takes discipline, that takes understanding, that takes education. So the greater awareness that you have of what you're doing and why it specifically applies to you and your spouse or your family, that's where you take solace and you embrace it and you say, this is definitely my plan. There's no one else on the planet that has that plan, that has those time horizons, those terms and conditions, the amount of liquidity you want, the rate of return that you want, the level of complexity that you want, the tax efficiency that you want, high, medium, or low, the amount of time, labor, and effort on your part. All those are terms and conditions that are peculiar to you and to your spouse. And when that suit fits exactly the way you want it, you embrace it and it embraces you.
I want a plan that's as spiffy as your star tie.
Oh,
Can that happen?
Thank you.
I need to get that for my husband. Are there any other questions in the audience? Yes, sir.
Yes, sir.
Elisha, and I was going to ask this question to the gentleman. All my life I've been a coin collector, and I've bought silver bars, and I've done extremely well. I know what I'm doing, and in fact, I sold a bunch of silver bars about 6 years ago, years ago, when silver went up to $40-some an ounce. I paid about $3.50 an ounce. And I buy metals from the U.S. Mint. I pay no sales tax out of state. I put the stuff in different safety deposit boxes. And when I buy it, there's no commission. When I sell it, it's cash. Now, and I'm listening to every word you're saying. What is your opinion on precious metals?
What you've described, if I heard you right, was that you bought and you sold precious metals and coins and silver, etc. That is a business, and sounds like you know that business. So the best advice when it comes to building wealth is with business. I mean, whether it's that business or a tire business or a real estate business, that's a business. And that is a function of your expertise at it, you're willing to take the risk at it, the time and effort that you're putting into it. All those are criteria and characteristics of a business owner. Most people may not care to take that kind of risk or to take that kind of effort and interest in that particular subject. So what you have described, I have heard on quite a few times.
But do you believe that people should, like Elisha was asking, should they have something in their portfolio, whatever you want to call it, in precious metals?
That doesn't usually come up in the portfolio, but if I were talking to you, I would encourage you to continue to do what you're doing because you've got that nailed. You've got it down. You understand what you're doing. So to answer your question, precious metals and coins doesn't usually show up unless it's a particular sacred cow to someone. And that's another term and condition. So, and I have lots of clients who have gold coins and silver coins, etc. And that's a sacred cow, meaning that it is their thing. But what they're not doing what you're doing. They're simply doing it because they think the world may come to an end. And that's
or like that TV show on Nat Geo. Has anybody ever watched that? Like the people that prepare for the apocalypse kind of thing?
Yeah. But if that happens, who's going to take your coin? It's like, I don't know.
Who are you going to bid with if everybody else is dead? Yeah. The gentleman in the yellow shirt, I believe, had a question.
Thanks. Yeah, I was going to ask you, in terms of equities, how much attention, if any, do you pay to analysts?
Analysts are usually extremely good. The common perception, I think, is fairly accurate that the market is efficient. So analysts, that's all they do 24/7, and they've got more than enough software and everything to. So, and they tend to also shoot first and ask questions later. So that is institutional thinking, meaning when they look at, they have a portfolio of several $1 billion. An institution, the distinction I'm trying to make is that an institution doesn't get sick, it doesn't need elder care, it doesn't have children. So they're simply thinking in a time horizon that is not it's not in the human scale. So what I'm trying to say is that, yes, I do give credibility to the analysts that they are assessing what the value of a stock is at a particular time. Who am I to argue with that particular valuation? They know more about that than I do.
Then you have one group that says, yeah, they're high on it, it's a strong buy, and then other quality analysts says it's a strong sell.
That's the magic of the market. Is that people are having to put their money where their mouth is, and there's risk involved there. And sure enough, the winner gets the reward. So that's where the rubber meets the road. And so I don't get into that. Is what I'm saying to you. That's their bailiwick. But the outcome, I respect the outcome of who turns out was right or wrong.
Any other questions? Yes, sir.
I'm sure when you were younger,
I was younger.
I know. Your business was probably a lot easier because of the magic of compounding, is what you were talking about in your original statement. But over the last 8 years, with interest rates at zero virtually, that has helped the market because there was no other place to put your money. So that has caused the market to go up a lot more. But at the same time, there was a hardship on people, retirees, people who were expecting interest rates to support their retirement. That has caused a lot of angst, I'm sure, among the type of people you're talking about, the retirees, the people that want to retire. And so it's made your job probably a lot more difficult to be able to ferret out those kinds of investments that can make a reasonable return at a reasonable risk and not an unreasonable risk, which is what a lot of people have been forced to do in getting into the market.
I'll try to repeat the question. The essence, I believe, tell me if I get it right, is that in the past, for instance, since the 1980, interest rates have consistently and gradually gone down to they've hit bottom, and that theoretically that was easier to invest money in that time, especially for seniors. Seniors, as a result, came to expect that at retirement they would get a higher interest rate or some interest rate that they could count on, and therefore now they have to take more risk in order to get that. So I absolutely agree with that. That is the history. What is interesting is that it has changed our perspective and our need to change our perspective as to what an investment can and does produce. For instance, we've all over that length of time, and in fact, as you can probably heard all kinds of data on the market, the average growth rate of the market, the stock market, S&P and Dow, is about 10% per year. But in that for the last 100 years, inflation has been about 3%. So 10 minus 3, the actual purchasing power is only growing by 7. So now, if you're getting 7 in the market and inflation is 1, the purchasing power is actually still about the same. That does not relieve the stress because you now do have to take more risks to get it. So your point is well taken. But the good news is that the pattern of growth and economic growth and wealth continually to be produced is still there, thank goodness. But it does, I think, add more angst to the senior who is looking who doesn't want to think about the market. They just want to know that they're going to get their 3 or 4% or whatever. Yeah.
Okay, I think we have time for one more. Yes, sir.
$100. How should I invest it for when I'm older?
Richard, 11, congratulations for even being here.
Yeah.
And for asking
Way
that
to go,
question.
Mom.
Terrific. Here. He's 11 years old. He says he has $100, and how should he invest it? So the key to that question is when it is that you're going to need or want to take that money, and how disciplined you are to actually wait to that time.
30s?
30s?
I want to go to West Point.
Good for you.
Outstanding. He wants to go to West Point. He wants to go to college. So the first thing I would actually recommend is I would take you to the side and I whisper in your ear that you convince your parents that if you put in 100, that they put in 100 for you. Number one. Number two, then I would recommend that I'd whisper in the parent's ear and say, if the deal is you'll contribute the 100 if he promises not to touch it until college. So almost no matter what grade of return you get, you're going to be ahead. Both of you are. I think you'll both be happy. But
Is that a one-time 100?
Good question. Is it a one-time 100? Thank you.
He's on an earning of right now, he's earning on his own right now about 100 every 6 weeks. So it's not too bad.
I'm impressed. That's terrific. So if you're going to be putting in every 6 weeks or so, just the accumulation of that will be very good. You're 11 years old, so you've got 7 years
to college.
7 years to college. I would put it in a balanced fund, 50-50, because there's going to be some volatility between now and then. A balanced fund simply being half bonds and half equities, because the money needs to be there in the 7 years. So by the fifth year, then you start skewing it more toward the bonds because you're going to be taking it out pretty soon. So 50-50, and then 2 years before, you start skewing it toward the bonds.
Bob, thank you so much for
You're
being here with
very
us
welcome.
today.
Thank you. Thank you very much. Thanks, everyone.